Let's dive into our weekly review to see what's going on with the stock market. And as always, this is coming straight from Macro Ops, our global macro research and consulting firm. So the first big thing is that the 10-year yield broke out from its multi-month range last week, and it's now back to its highest level since June. You can see that right here. Now, this is an important signal, and if this move in yields is durable, meaning it holds, then we should see corresponding breakouts in small caps, which I hope you guys jumped on that small cap system this weekend. This is what I was talking about. If you didn't, shoot me an email and we'll see what we can do. But it should help with that breakout in small caps and then also in yield sensitive industries. And energy and financials are going to be at the top of that list. And you know we've been covering energy in particular for a while now in these videos. So Ned Davis recently published a report making the case for a strong rally into the end of the year. So they point out that Q4 shows the strongest seasonality in recent years, especially while in a secular bull, which is exactly what we're in. Their risk on risk off diffusion index shows an improving risk taking backdrop coming off low levels hit last month. So people want to take risk, meaning they want to buy equities. So NDR writes that if the total of the two indices rises above 100 from its current level of 67, then it will provide a strong confirmation of a year-end rally driven by expectations of assertive economic growth. And this risk on, risk off is important because we know that sentiment drives markets. Sentiment also gets tied in with expectations, right? So if they're expecting strong growth, they want to invest their money. NDR's risk on cyclical consumer ratio has started to recover, which is consistent with the rally driven by reversing economic sentiment. Once again, sentiment here. People are bullish. But, sentiment is a little tricky because if they're too bullish, it's a bad thing. But in this case, yes, good thing, because it's not euphoria. And relative credit performance is also confirming an improving risk backdrop as well, despite the recent dip in equities that we had. And remember what I was saying about the whole China real estate thing? It was likely a non-event. Yeah, there was a big reaction in the market, but the underlying fundamentals still say that, we're in a massive bull. So this type of positive divergence between credit and stocks usually ends with stocks converging upwards. And remember, credit markets lead equity markets. That's why we use this as an indicator. You can see the red line going up, stocks should follow. The two best performing sectors year to date are energy and financials. And we already talked about how they would benefit from this 10-year breaking out of its range. Real estate is a close third, and we expect this outperformance to continue. So those are definitely good areas to look at. Now, even though everything we've been talking about is pretty bullish, there are some compelling bearish cases as well, like the one from Mr. Blonde Macro. He says that slowing growth, deteriorating cyclical earnings revisions breadth, and crowded positioning make the market ripe for a painful decline. Now, we don't disagree with this, and we think it will play out within the next couple of months. But remember, everything in the markets is about time frames, right? Not only time frames, but how your system works with those time frames or strategy or whatever you're using. And timing in markets gets very difficult as it is. So even though we believe this, as of now, the technicals tell another story, and the conditions for a larger top have not been put in yet. So we haven't really seen that buy climax conclude. So we think we got one more leg up before we see that multi-month correction, which we've been talking about for a long time. But again, this stuff isn't set in stone. You got to play it week by week. Or I guess, again, depends on your time frame. For these videos, yeah, we are doing week by week. If you're truly long-term, you'd just be holding through all this anyway. So as always, we'll be watching the tape and changing our opinions and positioning accordingly. So the S&P is currently above the midline of its monthly bar right here, which is this red line. So the bulls need the market to close above this level, and the bears want to push it below by month's end. And we only got a few more days left, right, in the month, so we'll see who wins out. And obviously, it's bullish if it lands above and bearish if it lands below. And in the next update, you will see us look back at the monthly chart to see what happened. The more you zoom out, the better the signal to noise ratio is. So stay tuned for that next week. Now, there are two big developments underway, both of which will have an outsized impact on macro over the next 12 months. The first one is China's clampdown on speculation in its real estate sector. And if you've been watching AK News, which is our other channel, and all the sketches we've been doing about China, you know the clampdown is on much more than the real estate sector. They're clamping down everywhere. They're not even letting kids play video games anymore. Complete communist control, CCP, so much fun. But this is the most recent and biggest because real estate in China affects a lot of things across the world, as we'll see in a second here. But the second update is the Fed's recent and surprisingly hawkish shift, which is bringing forward the pricing of rate hikes. These guys just always going back and forth. It's just such a stupid game. But here you can see how China's real estate is correlated with the base metals index. Because when they're building, they make up a huge part of the demand for metals. So if they're clamping down on real estate, that's not good for metal prices. The demand is going to fall through the floor. So BHP is the world's largest producer of copper, which is used to build Chinese real estate. And its stock has collapsed over the last 2 months, which gives us good reason to watch copper closely here when we're talking about the actual spot metal. Because BHP often acts as a lead on that metal. So there will likely be a potential short coming on copper. And that's what we do in the macro ops portfolio. Now, you guys remember GoPro? Yeah, probably haven't heard about it for a while, but back in 14, it was so hot. And when I say 14, I mean 2014, of course. But everyone was pumping that stock saying it's not a hardware play, but a new digital media company. You know, all the hype that goes into every IPO, we're still seeing it today. And that stock ran up to stupid valuations, but eventually, collapsed. But of course, their CEO was real smart getting all his money out. Now GoPro is what we call a left for dead play. So it gets very little coverage and it has hardly any fanfare. The hype is gone. So we like to check in on these hated, burned out names from time to time to see if the fundamentals have changed. Because if the fundamentals have changed and the price is so low on these, then guess what? You're getting a great deal. So you can occasionally find amazing transformations matched with dirt cheap valuations because of the hangover of bad sentiment when it's so strong like it is with GoPro. People don't want to look at it because of how much of a mess it was, when it ran up to those stupid valuations and then collapsed. People are still burnt. So that's what we may now actually have here with this little camera maker. So GoPro started selling direct to their consumers through their website last year, which now accounts for over 50% of their sales. And it boosted their margins by over 9%, which is amazing. They also launched a subscription business where they charge people $50 a year, which gives them access to a bunch of different benefits, like increased cloud storage, discounts, and video editing software. And the rollout has been very popular. And GoPro should now do close to 100 million in recurring sales next year. Can you believe it? And that's only from the subscription alone, most of which will be gross profits. Now, the stock currently trades for 12 times EPS, and we should see a sharp pickup in sales this year and the next as people get outside and start filming stuff again. Now, technically, if you look at this chart, it has broken out of a multi-year base and it's formed a larger bullish wedge. So we should see a breakout to the upside soon. So this is definitely one you should add to your watch list. And as always, if you want to take all the work out of investing and just automate it like I do, make sure you check out our training right here. It'll teach you the exact strategy and system we use. I'll put a link to it in this video and down below in the description and comments. I personally like doing almost no work at all and still getting great returns. So if you like that too, check out that training. So click this button right here and I will see you there.